So you see a stock price pop up on your screen, but what does that one number really tell you about how much a company is worth? Well, a lot of the time, it's not the whole story. Today, we're going to look beyond that simple price tag to figure out the real value of a business. We'll use two super powerful tools that can show you where the hidden traps are and where you might find some amazing opportunities. Let's get right into it.
Okay, just imagine this. Someone offers you the chance to buy the entire Ad Labs Imagica theme park. We're talking the land, the rides, everything for just 22 crore rupees. I mean, that's less than what some people pay for a fancy apartment in Mumbai. It sounds like the deal of a lifetime, right? But is it?
You see that initial price, that 22 crores? That's what we call the market cap. But as we're about to find out, it rarely, if ever, tells you the complete story. To get to the true price of a company, you got to dig a little deeper.
So market cap itself is pretty straightforward. You just take the price of one share and multiply it by the total number of shares out there. It's basically what you'd pay to buy up every single piece of the company on the stock market. It's the first number most people look at to get a sense of a company's size. Simple, right?
But here's the million-dollar question, or in our case, the 22 crore rupee question. If you were actually going to buy the whole company, is that market cap your final bill? Or are there some hidden costs lurking in the shadows? This is exactly why looking at just the market cap can be so misleading.
To find that real cost, we need a better tool, and that's where enterprise value, or EV for short, comes in. This is the number that gives you a much more realistic picture of what it would actually cost to take over an entire business, baggage and all.
Let's break this down with a really simple example. Say you buy a little corner shop for 100 rupees. That's its market cap. But when you get the keys and open the cash register, you find 20 rupees inside. Hey, that's your cash now. So your real cost just dropped to 80 rupees. But then a supplier shows up and says the old owner owed him 10 rupees. Well, you own the shop, so you have to pay that debt. Your cost goes back up to 90 rupees. And that 90 rupees? That's the enterprise value.
And that little shop story perfectly explains the formula for enterprise value. You start with the market cap, you subtract the cash the company has, because that becomes yours, and then you add its debt, which you now have to pay off. What you're left with is the true all-in cost of buying that business.
So why do we care so much about this? Well, because understanding EV can literally save you from walking straight into a financial disaster. And on the flip side, it can help you spot these incredible hidden gems that almost everyone else is missing.
Let's circle back to our theme park deal. The market cap is that super tempting 22 crores. But now look at the enterprise value. It's around 1,100 crores. That's a 50 times difference. Whoa! All of a sudden, that bargain looks totally different, doesn't it?
So where on earth did that huge number come from? Well, as you can see here, it's a mountain of debt. When you buy the company for 22 crores, you also inherit over 1,000 crores in debt that you are now responsible for. So the real price isn't 22 crores, it's over 1,100 crores. Phew! Understanding EV just saved us from making a massive mistake.
Now what's really cool is when this whole formula works in the opposite direction. Every once in a while, you can find a company with a negative enterprise value. And let me tell you, that is a very rare, very interesting situation for an investor.
Let's go back to our shop one last time. Imagine you buy it for 100 rupees. But this time, you open the cash drawer and find 120 rupees inside, and the shop has zero debt. Think about it, you've actually been paid 20 rupees to take over the business. That's a negative EV. It happens when a company has more cash in the bank than its market cap and debt combined. It's a huge green flag that says, hey, you should definitely take a closer look here.
Okay, so now we know how to figure out a company's true price, but there's one more really important detail. To make sure our numbers for cash and debt are even accurate in the first place, we need to be looking at the full picture, and that means always using consolidated financials, not the standalone ones.
So what's the difference? Well, standalone numbers just show you how the main parent company is doing, all by itself. Consolidated numbers, on the other hand, combine the parent company with all the other businesses it owns or has a big chunk of. It's like looking at the complete family photo instead of just one person.
And here is a perfect example of why this matters so much. If you just look at Tata Motors' standalone sales in India, you see about 70,000 crores. But their consolidated sales, which include their ownership of Jaguar Land Rover, are a jaw-dropping 300,000 crores.
If you ignore the consolidated view, you'd have a completely warped idea of how massive this company really is. All right, let's switch gears and move to our second key metric for today, the price-to-book ratio, or PB. This is another really useful way to ask that fundamental question. Is this company cheap, or is it expensive? So, to get PB, you first have to understand book value. Put simply, it's the value of a company's hard assets, stuff you can touch, like its factories, its machines, land, and cash, after you subtract all its debts. It's what shareholders would theoretically get back if the company just shut down and sold everything off today.
Let's make this real. There was a time when you could buy a share of Tata Steel for 277 rupees, but its book value, the actual value of its physical stuff per share, was 593 rupees. That gives it a price-to-book ratio of less than 0.5. Just think about that for a second. You could buy a piece of the company for less than half the value of its actual physical assets.
Now, a low PB ratio can definitely signal a bargain. But, and this is a really big but, the PB ratio is only useful for certain kinds of companies. If you use it on the wrong type of business, it can be totally misleading.
And here's why. Book value only counts physical things. So for a company like InfoEdge, the one that runs Naukri.com, what's their most valuable asset? It's not a giant factory. It's their brilliant programmers, their software, their brand. But according to accounting rules, people and code aren't assets on the books. That's why these companies can look super expensive on a P/B basis, even if they're a fantastic investment.
So here's a simple rule of thumb. For asset-heavy industries like steel, cement, or power, where the value is all about the massive plants and equipment, PB is super useful. It's also great for banks because their assets are financial, loans and deposits, which are clearly accounted for. But for IT firms, service companies, or businesses with incredibly strong brands, their real value isn't on the balance sheet, which makes the PB ratio pretty much useless.
So there you have it, 2 new tools for your investing toolkit. Enterprise value helps you find the true cost of a business, forcing you to look past the sticker price at the debt and cash hidden inside. And the price-to-book ratio lets you compare that price to a company's hard, physical assets. So the next time you see a stock price, don't just take it at face value. Ask those deeper questions, because more often than not, the most valuable finds are hiding just one layer beneath the surface.